All right, so we've spent some time looking at the super rational models of modern finance, but we've also started to see some of the cracks in that foundation. And that leads us to a really important question. Is behavioral finance a total replacement for those old models, or is it something else? Let's dive in and find out.
This question really gets to the heart of it all. We've got these beautiful, elegant, logical models that tell us how markets are supposed to work, but then you just look at the real world. The crazy excitement of a bubble, the sheer panic of a crash, and it feels a whole lot less like a spreadsheet and a lot more like, well, like people being people. So what's the missing piece here?
To really get what's new, we've got to look at what was wrong with the old stuff. I mean, those elegant theories of rational finance, they were fantastic, but they were starting to really struggle under the weight of what was actually happening out there in the real markets.
Remember those two big pillars we talked about, equilibrium and arbitrage? So equilibrium gave us these really neat pricing models, but they were all based on some pretty big what-ifs. And arbitrage, you could think of it as the market's police force, was supposed to just swoop in and fix any mistakes instantly. But it turns out, even that police force had its limits.
And these limits, these weaknesses, they created all these real-world puzzles that the old models just couldn't solve. I mean, why do stock prices swing around so wildly, way more than the company's actual values are changing? And why do some stocks that are winning just keep on winning for way too long? These weren't just tiny little glitches. There were some major holes in the whole system's logic.
So, since the old financial models were coming up short, a brand new idea started to pop up from a completely different field, psychology. The big question became, what if the key wasn't in the math, but actually in the minds of the people who were making the trades?
And that brings us right to behavioral finance. The core idea is actually super simple, and honestly, it just makes sense. Markets are made of people. And people, well, we are not always the perfectly rational, calculating machines that the models wanted us to be. Nope, our decisions get influenced by a whole bunch of psychological quirks and biases.
And these aren't just some abstract theories. These are well-documented tendencies we all have. Take loss aversion, for example. We absolutely hate losing $100, way more than we enjoy gaining $100. Or think about overconfidence. That's what basically fueled the entire dot-com bubble, right? Investors just believed tech stocks could only go up. The main point of behavioral finance is that these biases don't just disappear when we start investing. They come right along with us.
Okay, now this is the single most important question in this whole debate. It is the classic defense of efficient markets. Okay, sure, some people are rational, so what? Shouldn't the really smart, rational traders, the arbitrageurs, just trade against them, fix the prices, and take all their money? It's a great question. Why would a wrong price ever last for long?
Well, the answer is in the limits of that corrective force itself. Arbitrage, the supposed enforcement arm of the market, it's just not the superhero we all thought it was.
This quote right here is basically the modern synthesis of finance in a nutshell. It's a two-part story, and it's so important. First, our own psychological biases create the mistakes, the errors in market prices. But second, and this is key, it's the real-world limits on arbitrage that stop those errors from ever being fixed.
So here's how it plays out. Step 1, a big wave of investor excitement, maybe driven by a bias like overconfidence, pushes a stock's price way off from its true value. Okay, now step 2, the rational traders, they see it. They know the price is wrong, but fixing it isn't easy. Betting against a stampeding herd is incredibly risky, and it costs a lot of money.
And this is the real gut punch for that pure arbitrage theory. You've probably heard the famous saying, the market can stay irrational longer than you can stay solvent. An arbitrage trade is not risk-free. A price that's wrong can always get even more wrong before it gets better. And if you run out of capital before that price finally corrects, you lose. It's not just about being right. It's about being able to survive long enough to profit from being right.
So where does all this leave us? Does it mean we just throw out all those old rational models? No, not at all. What it really means is we should see behavioral finance not as a replacement, but as a crucial, necessary addition.
I think this comparison is a fantastic way to look at it. Think of the rational models as the perfect architect's blueprint for a building. It describes the ideal structure. Then, think of behavioral models as the engineer's report from the real world, explaining why the building actually has some cracks and leans a little bit because of, soil conditions and human error. One describes the ideal, the other explains the messy reality. And you absolutely need both to get the full picture.
So the big takeaway here is a much more mature, more nuanced view of markets. They aren't these perfectly rational, calculating machines. But they also aren't completely chaotic, random casinos either. They're these complex systems where a really powerful force of rational discipline is in a constant tug of war with the messy, predictable, and very, very human forces of our own psychology.
Now, this new, more complex view of the market has a massive implication. If we can't fully trust market prices to be perfectly rational all the time, then we have to start looking deeper. We have to go straight to the source of where value actually comes from.
It's really just a logical next step. Markets don't create assets out of thin air. Firms do. And if the external pricing mechanism, the market, is imperfect, then the internal decisions that are made by the people running those firms become exponentially more important. The focus has to shift from just the price of risk to the actual control of the resources that create that risk in the first place.
And that right there sets the stage perfectly for the next chapter in our story. We've talked about risk, we've talked about rational markets, and now the psychology that can crack them open. And all of it points to one fundamental question. If the market is imperfect, then who inside the firm is actually calling the shots? Who controls the capital? And that is exactly what we're going to explore next.